Good afternoon to everyone present in the for the discussion session, and welcome to the second discussion session of the year 2026, where we'll be discussing the first half performance of the company for the year 2026. So as you have all, there will be no presentation as such, as usually we discuss the during these discussion sessions. There will be no presentations as such. And having said that, I will just give a brief about what has been the performance of the first half. For the first half, the revenue has been flat over last year. This is in spite of the the challenging environment we had especially from March onwards in the region. And however, we have delivered a net profit in excess of 650,000 Real money. We are at about 666,000 to be precise, which is about representing a growth of about 25% over last year same period. And the highlight of one more highlight will be that we have this 666 also represents higher than the entire year profits which we did in 2025, which means if we are able to sustain this profitability, we will be more than doubling our profits for this year as compared to last year. And coming to the brief parameters or based on which we were able to deliver this is one is it was aided by the anti-dumping duty, which was continued in the local market in Oman. So that helped us considerably to consolidate further on the market in Oman. And also the volumes were to some extent, in fact, impacted in the other export market because of the going on war here. Otherwise, the performance, the bottom line could have been even more better if we had been able to export a few more, or even if we had exported the same levels at what we did last year. So that is one impact. And Oman market is doing extremely well. We have grown decently well, whereas the export market, especially the Saudi, the Qatar, Bahrain and Kuwait and all has been impacted. So that is where we stand in terms of the market-wise performance. Whereas there has been escalation of our input cost pressures are there, which we are managing by cost optimizations and then process controls, and also by seeing whether we can improve on our realization, the selling prices, which will be seen in the coming quarters, which we have already implemented, the selling price increases, which will be visible in the coming quarters. With this, I'm sure all of you have done your detailed number crunching and number analysis of the numbers which we had already disclosed. So I leave the floor open for any questions, and then we will be able to answer you to the best of our ability and whatever is relevant. The floor is open for any queries now, please. Yes, Mr. Mohammed Zali, I think you have a query. Please, you have to unmute yourself, please.
Good afternoon. Am I audible?
Yeah. Sure. Please go on, Mr. Mohammed. Yeah.
Okay. Good afternoon. Thank you for your time and congrats on the H1 results. 3 questions from my side. The first question is, as you mentioned, that the H1 net profit increased, but we realized that the operating cash flow declined by around 23% and receivables increased by about 17% from the year end. So what is driving this deviation between the earnings and cash generation? And should we be concerned about the longer collection periods or customer credit quality going onwards?
Yeah, Mohammed, I think you have a very, very pertinent and a very valid question. See, my clarification for that will be, see, the increase in the receivables is basically because you are the the revenue growth in the first half as compared to the second half of last year has been quite phenomenal. If you see, our revenue has grown by almost more than $1.5 million over the last 2 quarters of last year. When the base was lower there, that is why it appears that our receivables is also higher. And whereas our receivables, in fact, the quality of our receivables has improved in the first half as compared to the year end.
Okay, so clear. Moving to the second question.
Yeah.
I'm asking about any updates regarding the stake sale in the Anwar Ceramic. Have there been any discussions with any strategic investors, and how do you see this potential change in the one of the largest shareholders affecting the company in a strategic manner?
See, as of now, I do not have any information to share because I haven't heard anything from the strategic investor as of now regarding any prospective buyer in the pipeline or anything. And in that I think that pertinent question can be raised in the discussion session when they come up for in the next couple of weeks. They also must be coming up. Al Jazeera Services, who's the holding company of ours as of now, they will also be coming up for their discussion session, and then maybe they will have more information on that subject.
Yeah, clear. So my last question is, with the improving profitability in H1, how should we think about the dividends going forward? Like if we assume that the earnings continue to recover in H2, is there any possibility to increase the dividend payout, or would you prefer like to retain more cash?
I mean, that actually is a prerogative of the board. Okay, but as we have already declared our dividend policy, if you see, we will be taking a very conscious call depending on whether any requirement of cash is required for any expansion necessities and things like that. Otherwise, the payout should be in line with what we have done in the past.
Okay, clear. That's it from my side. Thank you.
Yeah. Yeah. I think Mr. Ashish Bhatnagar, please, you can unmute yourself.
Yeah. Yeah. Hello, sir. Just
Hello.
wanted to know, have you any plan to open the new showroom in H2 or H3? Because I noticed that some showrooms are closed in the previous year, which are not open.
I mean, see, it's a continuous process. We don't have any showrooms of our own because they are all the showrooms of our dealers. Sometimes they relocate their showrooms, and the opening of showrooms by the dealers is a continuous process. In fact, this year we must have at least about 7 or 8 new showrooms that has been opened in the various regions of Oman itself. So there is no dearth of our showrooms in the country today.
And you told about that advantage of anti-dumping duty, which is driving the sales. So do you aware of the government policy for the next 1 year or something, that how long that will be continue? Anything you can give a light on that?
Yeah, see, the anti-dumping has been renewed this February by the GCC Council and extended for a further period of 5 years. Okay, so this is the information which we have now, and then the decree also we have a copy of which is available even when you Google it and check it out, which means the anti-dumping should be in place for the next 5 years from this February onwards. So unless the government decides to partially withdraw it, which is not going to be very easy, and also the CEPA agreement entered into between India and Oman government also stipulates that they are going to the anti-dumping and any restrictions that is there because of these kind of investigations will stay, and that will not be affected or it will not impact the CEPA agreement, the free trade agreement between the countries. So we reckon, or we believe that it should be there for at least the next 4.5 years, assuming that we have already gone by 6 months now.
And you also spoke about the challenges of the cost because of the war.
Yeah.
So do you anticipating that that will affect the second quarter and the third quarter also, or it is now over? What is the current situation now?
No, as I said, there are challenges in terms of the input cost escalation, but that we are now countering by ensuring that we are taking the appropriate price increases to ensure that we cover up on the escalation of the cost. So which already we have affected, and then it shouldn't affect the bottom line if we are able to sustain our volumes and the top line.
You must be been continuing touch with the exports. So how you see that the H2 and H3 quarter for the export when you're talking about to the Saudi market or the GCC market? Anything you can give some detail?
Okay. Yeah, sure. Sure. I mean, okay, the export is basically impacted now due to the very high freight costs. See, the freight cost because of the war situation, both the road transport as well as the sea transport, especially sea transport intra-Gulf is almost nil now because of the situation. We are not able to send anything. Even by road, which we were able to transport in the prior to the war, now that has gone over the roof in terms of the logistic prices. So once the war comes to an end, or at least it stabilizes, the situation stabilizes, and then we are able to go back to normal situation, then I'm sure that we will be able to go back to those markets and then see how we can regain those markets.
Thank you, sir. Thank you for the clarification.
Yeah, Mana, please unmute yourself, please.
Good afternoon. Thank you for this call.
Good afternoon.
When I look at the margins, it has been improving in the first quarter as well as in the second quarter also. It has been improving. I just want to understand, like, is this sustainable? Can we expect this to continue in the second half as well?
Exactly. That is what I was just detailing a little time earlier also. If we are able to sustain the volumes and the top line, the margins are clearly we will be able to sustain it. Because as I already explained that we have already trying to improve our realizations to cover up our escalation in our input costs.
Okay. And what is the current utilization rate?
Currently, we are in the range of 70 to 75%, depending on what product and what we are doing. Yes.
Okay. Thank you.
Yeah, Kushal. Please go ahead. Please unmute yourself.
Yeah. Hi, Mr. Suresh. Thank you for the opportunity.
Yeah.
Can you provide any, the situation of KSA market? What are the demand dynamics and how's the ground reality?
Yeah, in the KSA market is actually what do you call? It's quite stagnant, I would say. I mean, we don't see that there is any growth in the market. At the same time, there is no degrowth as such. But whereas, as we have also said in our chairman's report, the increase in capacity is there, is also flooding the market. So at the current freight levels, we are not able to compete there, and the viability of our products entering those markets with such a high transport costs is becoming very difficult at this point of time. Once it stabilizes, probably we can go back there, because of the volumes which we were looking there as compared to the overall market is very minuscule. It's very, very low. So to that extent, once it stabilizes, we will be able to get back to that market, at least to whatever levels we were doing earlier, without any problems.
Thank you.
Yeah, Sandesh, you have to unmute yourself, please.
Yeah, hi. Am I audible?
Yeah, sure. Please go ahead.
Yeah, I just wanted to understand your mix, your revenue mix in terms of your domestic and your export market, like how much percentage is from domestic and how much is from export. And even in export, like in GCC, like if you could give some idea on how much is from KSA or any other country.
Yeah. See, I would say now in the current scenario, and especially for this first up, historically, it has been always about 45, 50 to 55% was local, and then 45 to 50% was exports. Whereas this first half, because of the challenges which I explained earlier, the local market we have been has contributed almost 65 to 70% of the volumes, and the balance 30%, 35% is in the export market.
Okay, thank you. And my second question.
Predominantly, it is the GCC. See, the major contributor is in the GCC, apart from a few other markets like Yemen and Jordan and other things. Yeah.
Also, post the anti-dumping, how has been the how was the pricing dynamics in terms of your domestic market? Like how are the prices have been like how did it started fluctuating since May 29th, 2025? How did you see the prices going forward till today?
No, prices have been very stable. Our first goal was to increase our volumes and see how we can increase our capacity utilization than looking at the pricing. Because when we increase our capacities, there is an advantage for us to amortize our fixed costs over a larger volume. That was our basic intention in the once the anti-dumping was there. Now we have, though we have not still able to, I mean, we are not in a position to what do you call ramp up our capacity utilization further higher because of the war situation. We are looking at an increase to offset the increase in our costs.
Okay, understood.
Yeah.
Thank you. Thank you for it.
Yeah. Yeah, Joyce. Please unmute yourself. Yeah.
Hi, good afternoon, sir.
Yeah,
how are
hi,
you?
good afternoon. Fine, thank you, Joyce.
So,
Yeah.
so just wanted to take a stock of the current inventory situation in the domestic market. How do you see the inventory situation, especially when we are talking about lower imports, and there are only two major players producing the tiles. So, what's the current inventory situation, and also on the demand situation? How do you see the demand? If you can quantify it, it will be much appreciated.
Okay. See, quantifying in terms of absolute numbers may be difficult, but as a percentage, I can tell you that there has been a substantial reduction in the inventory of the imported materials which used to be there in the last few years, because new imports have not been able to come in because of very high freight costs, and also there has been a substantial increase in the gas costs and what do you call on the input costs, even in the manufacturing areas in India, which was one of the major country which was exporting into Oman. So to that extent, the inventory has substantially come down. That is very visible because we have our local demand has considerably increased, and in fact, we are looking at further growth in the Oman market because of very low inventories of outside materials. But on the quantification side, it may be difficult for me to quantify as to what percent. I mean, I would say that maybe what is available in the market now may be less than 10 to 15% of what it used to be earlier.
10 to 15% lower.
No,
only
it is almost, I would say 80% lower.
Okay. And how do you see the demand when you're saying that the pressure from imports are reducing, but at the same time, you were pushing only very small marginal improvement in terms of sales. Is it a function of overall demand coming down, or is it something else?
No, the overall demand is not coming down. All this time, probably what happened was they were all liquidating whatever inventories they had. So we will have to wait and see. The next 2 quarters will be very crucial for us to understand the spike in the demand because of a lower inventory. Because up to almost the May or June, almost up to April or May, the inventory was being the old inventory was being diluted in the market. Okay, they also kept certain inventory because they thought probably they will also able to obtain a higher price and things like that. So now that it's all coming to an end, now we have to see whether there will be a spike. And as I also said earlier, even our local volumes have gone up, pretty substantially higher.
Okay. And what's the average realization that we had during the first half of the year?
The average realization was in the range of about.
From the local market, that's what I'm.
From the local market, was in the range of about 1.4, 1.45 kind of.
1.4, and what was it for total?
Almost in the same range, because when we say local market and exports, because exports predominantly we sell the what do you call grade 1, whereas this market you have all all grades are sold here, plus the what do you call the transportation cost to the other markets are little higher, so it gets averaged out.
So if inventory levels are lower and and demand is still intact, when do you expect to see some kind of a restocking by all these leaders?
It is going to be difficult. It might be very, very difficult in the near future because of very, very high what do you call freight cost. Today, freight cost is a big cost in the overall cost for bringing in the materials into Oman. So today, from India itself, it is anywhere between $2,500 to $3,000 per container. So which is prohibitive for anybody to bring in, which means they will have to spend almost $2 per square meter to bring in the material and keep it and sell it here, which will become very, very unviable for them. Added to that, even the base cost itself in India has gone up substantially because of increase in the natural gas cost there. It has gone up almost 3 times. So their cost of production has also gone up. So both put together, there is going to be some more time before it eases out, and then again the export starts from there into this region.
So my question was from the perspective of the local producers. So have you started seeing any of the restocking by any of these dealers coming up, or do you expect it to happen probably maybe by towards the end of the year or fourth quarter? Do you have any feelers on that?
No feelers on that. As I said, everybody is waiting and watching for the overall cost to come down. Otherwise, it's not viable for them because they will not be able to compete in the local market with the local producers, which will be substantial. Their cost will be substantially higher than what we will be able to provide here.
Yeah, if they cannot import at the same time, they can purchase from the local producers, right?
Yes, that's happening now. That started happening now.
Okay.
That's clearly visible. That's why I said next 2 quarters will be, you will be able to get an idea as to where we are heading towards.
All right. Okay. Yeah, that's it. Thank you.
Yeah. Somebody else wanted any question? Richa, I think Richa wanted to have a.
Hi, the questions are already answered.
Okay, fine. All right.
Thank you.
Okay. Thank you so much. Thank you. Yeah. Pritam, I think you can unmute yourself, please. Yeah.
Hello. Thank you for the call. I just had one question. So apart from freight costs, which obviously have gone up. Any other item in your cost base that has gone up or likely to stay elevated for the next 6 months?
Yeah, our input costs, like see, all our imported materials, the raw materials which we import from various parts of the world, especially from Spain, Italy, and some things from India and all. Even those input costs have gone up basically because of the freight. Even the inward freight also has substantially gone up with the war research charge and other things. So those things as a percentage of the total cost may appear to be low, but still there is impact on the our costing. That is where we said that we are now trying to pass it on to the trade.
Okay, but the energy cost remains steady.
Yeah, energy cost and other local costs and all remain steady. Yes, that's right.
Okay, thank you very much.
Thank you. Yeah. Any other questions? Any other queries? Any clarifications? Yeah, Kushal. You unmute yourself.
I just want to clear yeah. Am I audible?
Yeah.
So I just want to clear myself. If someone is exporting from India, under the CEPA, the custom duty is, not applicable, but the anti-dumping is still applicable, right?
That's right. That's right. That's
Thank
right.
you.
That is the minimum rates applicable there is about 42%, which can go up to 107%.
Okay. Thank you.
Yeah, sure. Any other queries? Yeah, Amit?
There is a question I think somebody asked in the chat box, sir. The question was, what were the utilization level in Q2?
Yeah, I think I replied that. That's why I think they must have already, I said that 70 to 75% utilization. I had already replied that, yes. Yeah.
Okay, perfect.
Yeah. I think someone is, yeah. Okay. Any other questions? Any queries? If there are no more queries, maybe we can wait for another 2 minutes before we conclude the meeting. Yeah, Mohammed, you have a query? Please unmute yourself, please.
Yeah. Just one question. When do you expect the utilization rate to reach around like 85, 90%? Because currently you're speaking, the utilization rate is 75 to 80%, if I'm not wrong.
That's right. That's right.
Yeah.
See, I think, the local market is supporting us quite well for the 75%. Okay, and then it can further go up also if it is going to further improve, and then the imports are going to be still not coming in. But we will be able to increase it more when the export market opens up fully for us. Because there we have, as I explained to you, the challenges is that we are not able to, service the export markets presently. If once the situation stabilizes and it opens up, I'm sure we will be able to increase our capacity utilization.
And any expansion plans you are intending to have in the short to medium term?
No, first, not immediately, but first we are looking at what do you call, the capacity utilization of 100% is our first goal. After that, we will be looking at.
Clear. Thank you.
Okay. Yeah, Sharur, I think you had Shaur, you had a question. Please unmute yourself.
Yes, hi.
Yeah, hi.
Thank you. I just had a couple of questions. Would you be kind enough to give us what was the utilization rate during this quarter, during second quarter?
Yeah, second quarter was, as I said, it's in the same range because the entire year, I mean, first half itself, it was in anywhere between 70 to 75%. We have been maintaining that.
Right. Okay. And when you talk about the price increase to pass on the additional costs, how much are we talking in terms of percentage if you were to give a ballpark number?
See, it also depends on product to product, okay, size to size. So I would say it can vary anywhere between 5 to 10%.
Right, and then 5 to 10% would still keep you competitive after the
right.
duties and from the
That's
import.
right.
So okay, and my second question is obviously the cost of production in India and the region has gone up, and that is partly why their commodity is also getting more expensive now. What if things resolve and the freights go back to the prices that they were before and the gas prices also come down? If things were to resolve like pre-war, would you be able to compete with the dump inventory after this anti-dumping duties?
Of course, of course. See, as I explained to you, maybe I don't know, you joined in a little late, I'm not sure. I was explaining also that the duties are anywhere between 42 to 107%, depending on who the exporter from India is. So whatever is the cost that is going to go down, even if they go to the pre-war cost levels also, still a 42% duty here is pretty steep. So it is going to be very difficult for them to compete with our pricing. And in which event, even our input cost also will stabilize, because today our increase in our input cost is mainly because of the increase in the freight cost which we are paying for our imported materials, which also will come down, and then we will also become more competitive at that point of time. Hope I have answered your question.
Yes, perfect. Thank you.
Yeah.
Thank you for the answer.
Yeah. Any other questions, queries? Otherwise, we can wind up. We can conclude the meeting if there are no further questions. We'll give another minute before we conclude. Okay, as we see that there are no further questions or clarifications, we will conclude this discussion session. Thank you, ladies and gentlemen who were present here. And yeah, any questions?
Thank you. Thank you, Mr. Suresh. Thank you very much.
Thank you. Thank you so much. Thank you, everyone. Okay, hope to see you all once again in the coming future. Thank you so much.